Hello, all you lovely people out there. How is everyone doing? I'm Kate Hill, and as always, I'm here to give you the best content on property, along with fabulous strategies, hints, and tips. And today, stay tuned for all your latest, quite lengthy property news. How inflation is impacting the housing market. The latest inflation figures showed headline inflation in Australia had increased to 6.1% in the June quarter, the highest in over 20 years, and the figures are impacting the housing market. We can see that the costs of renovations and building a new home have soared off the back of the home builder stimulus, very high demands for trades and materials, and supply shortages. The latest inflation figures confirm that the producer price index for the housing construction sector is going to look pretty bad. The cost of building a new home has increased by 20 to 30% in many cases, and we are expecting a lift in construction insolvencies, with many projects now being scrapped. And you'll have already seen and noticed this being reported in the media, of course. They love a dramatic headline. This has implications for a potential undersupply of dwellings as migration increases over the next 12 months. Rental price inflation has finally been beginning to show up in initial figures. The official inflation figures measure actual rents across the market rather than asking rents, and as such there is obviously a bit of a lag in the official data, with power and energy costs also rising. The ABS figures still have Sydney and Melbourne in negative territory over the year, so there is some catching up to do for this index to reflect what is actually happening in real time with asking rents for newly signed leases. To some degree, the ABS figures reflect weakness in central business district rents, with many tenants electing to move to the suburbs or into regional areas throughout that pandemic. With a huge backlog of visa applications to be processed and most new arrivals into Australia being renters, we expect to see strength in rents continuing well into 2023. There is also some evidence of tenants returning to Sydney and Melbourne in more meaningful numbers now. With inflation at the highest level in over 2 decades, there will inevitably be further rate hikes facing borrowers over the remainder of 2022. The good news is that market weren't really spooked by the June inflation figures, and in fact bond yields have dropped back to their lowest level since May. Markets are in fact probably pricing for interest rates to be on the way back down next year, which means that property buyers have probably got a window of a few months to buy with less competition to snag a bargain before the market picks up again next year. We have an awesome opportunity right now to negotiate hard and buy well-located property. Property prices remain stubborn. So while property prices may have begun to drop in some cities as a result of rising cost of living, they do remain extremely high compared with pre-pandemic levels. The latest market analysis from PropTrack shows that national average house prices are just 1.66% below their peak of 2021, after a 0.44% drop in July. Despite that, dwelling values remain 33% above what they were in March 2020. Now, that increase was driven in part by the huge rise in regional cities, where dwelling values are 49% higher than they were before COVID. While the latest figures show drops in Sydney and Melbourne, which are both down 3% since the start of the year, other areas are still recording price growth. In July, Sydney dwelling values dropped by 0.4% and Melbourne dropped by 0.61%, while Brisbane and Darwin recorded no change. Adelaide dwelling values increased by 0.4% in July. It's pretty rampant there still, while Perth rose by 1.2% and Hobart increased by 0.26%. So there is little evidence that the property market will undergo a sharp correction, according to many real estate economists, even though sentiment has shifted, and it's no wonder given the amount of negative media coverage regarding this. There is little actual mortgage distress among homeowners at the moment. As a result, it's hard to understand why so many forecasters were predicting these big price drops. The conditions are just not in place for that sort of house price declines that some of these forecasters were putting out there. Nerida Conisbee says that capital fund managers describe the current forecasts about house prices as nothing short of ludicrous. They say that low vacancy rates and growing rents mean that property remains a really attractive prospect for long-term investors. They say that in the current market, rents are rising at more than 10% per year. While borrowers may not like increasing interest rates, they will do everything they can not to default on their loans. They'll cut discretionary spending and look at cheaper refinancing options. The Reserve Bank of Australia Deputy Governor has dismissed concerns that interest rate rises will have a negative impact on the housing market. Michelle Bullock says that most households can handle a potential 3 percentage point increase in the cash rate. Now this, she says, is because many borrowers are well ahead on their mortgage repayments. They have significant savings and good equity in their homes. Michelle says that most borrowers had been assessed under very strict criteria in recent years to ensure that they could afford interest rate rises. It's how our banking system works. She says that the current cash rate of 1.35% must go a fair bit higher for the economy to reach a balanced level, while RBA Governor Philip Lowe says that a balanced or neutral rate is probably at least 2.5%. Australia's rental crisis is expected to worsen, with rents continuing to rise. I'm like a broken record with this, aren't I? PropTrack data suggests median rents are up 7% compared with June 21, and that is the fastest pace of growth the market has experienced for many, many years, with combined capital city house rents now averaging $500 a week and units $450 a week. Rents in regional areas have hit $455 for houses, $395 for units. PropTrack warns that Australia is still at the start of the rental crisis, and I agree. With overseas and interstate migration returning and a massive lack of supply because investors are not being encouraged to buy property and they are certainly not building enough, rental conditions will tighten further over the coming months and possibly a couple of years. The total supply of rental properties is down 18% on a year ago. Domain's latest rent report shows that both house and unit rents over the combined capitals have recorded their longest continuous stretch of rental price growth, with house rents rising for the 5th consecutive quarter and unit rents for the 4th consecutive quarter. Plans to increase migration into Australia will cause rents to increase even further, with the federal government indicating that it wants to fill labour shortages by increasing migration. This will put further pressure on the rental market. Think about the fact that migrants traditionally move straight into the cities, and they move obviously first into the rental market. It's that factor that is still missing in our residential rental sector. Now, the wheel has turned. We're seeing rental yields climbing really, really quickly. In cities such as Sydney, rental yields had dropped near 2%. We are now seeing them climb up towards 3%, and they could get to 4%. That's pretty huge for Sydney. Treasurer Jim Chalmers says a proposal to temporarily double skilled migration places to 200,000 to address critical labour shortages is a reasonable one, as the federal government plans a jobs summit to find common ground in the private sector. PropTrack's overseas search report reveals searches on realestate.com.au from overseas increased by 23% in June compared with the same time last year. Rental searches accounted for 71% of the overseas activity during June, while 7% of searches were for properties for sale. Searches from China dropped a massive 432% during June. India is up 197% and Hong Kong up by 100%. PropTrack believes that the current increase in searching activity is from migrants and students, not expats. It's not at levels yet that we were seeing pre-pandemic, but there are definitely signs that it is getting back to that level. Speculation that rising interest rates will force a number of borrowers to default on their mortgages is being materially overplayed, according to City economists. Analysts say that Above median household incomes are giving borrowers better financial flexibility to meet repayments, despite the RBA increasing the official cash rate to 1.35%. S&P Global Ratings analyst Erin Kitson says that mortgage arrears are at historically low levels, and she doesn't expect a significant increase in defaults given a strong labour market and the buffers built into serviceability assessments. Like I said earlier, Kitson says borrowers built up their savings during the pandemic as well as their repayment buffers, and they will use that to help absorb higher mortgage repayments. While savings buffers have of course been declining a little bit from their pandemic highs as the economy has reopened, they do still remain above the long-term average of 5%, she says. The City analysts say that while there is no doubt Australian property is expensive, mortgages are large, most borrowers can still meet their repayments. Now, we will keep you posted on all things property from around Australia as our year progresses. Please give our little video a like. Don't forget to hit the subscribe button, and I will see you all really soon. Bye.